If long rates stay elevated or go higher, then Schwab will likely lose their bank subsidiary because the financial forces will be above even their ability to finance. Charles Schwab has recently announced a massive wave of layoffs and even plans to close some offices to save around $500 million per year. But with the entire banking and financial sector being in trouble since the entire Silicon Valley Bank situation, investors are starting to become more concerned about their long-term positions within Charles Schwab, specifically the SCHD ETF, and want to know if their money is going to be safe. And of course, what would happen if Charles Schwab was to face worse challenges ahead? Well, make sure to stick around until the end of this video because we are going to answer all this and more. Right after you, please drop a like in this video and subscribe for more future content like this. So for those that might not be aware, SCHD, the Schwab US Dividend Equity ETF, is one of the most popular dividend growth ETFs that's ran by Charles Schwab. Now this ETF strategy and objective is pretty straightforward. The investment seeks to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. To pursue its goal, the fund generally invests in stocks that are included in this index. Now this is one of the largest ETFs in the entire stock market, with total net assets being around $49 billion as of last. And with the fund's inception date being in 2011, a lot of dividend growth investors, including myself, have a decent amount of money sunk into this ETF. And it's absolutely no secret that this ETF has been seeing some massive struggle as of the last year or so. The ETF is down around 2.2% year to date, trading in sort of the middle range of the 52-week range. And this is all while the S&P 500 index is up around 15+% year to date. Now looking at ticker symbol XLF for the Financial Select Sector SPDR Fund, the banking financial sector has had a very rough time year to date, with companies like Silicon Valley Bank actually collapsing earlier this year. And just when things don't seem like they can get any worse for investors, Charles Schwab just announced recently that they plan to cut jobs and close offices to try and save around $500 million as layoffs spread across Wall Street. The article says Charles Schwab is cutting an undisclosed number of jobs, the firm said last Monday. Cuts are related to the integration from TD Ameritrade, which was acquired in 2020. The brokerage expects the cuts to save about $500 million annually. The article then said the company did not disclose the number of employees it was going to lay off and did not immediately respond to the request, but several companies across America, including Wall Street banks, have trimmed their workforce this year in a bid to rein in cost amid still high inflation and deal-making slump due to higher borrowing costs. Now, because the Federal Reserve has consistently been raising rates over the last year or two now, it's been putting a lot of pressure on banks, especially banks and firms that do have a lot of money tied up in lower yielding assets. Because simply put, if a bank is earning say 2 to 3 or 4% on their money, but the interest rates are now above 4%, the bank is effectively running at a loss. So for the SCHD, the Schwab US Dividend Equity ETF holders out there that might hold on to hundreds or even thousands of shares of this popular dividend growth ETF, they might be wondering if their shares are actually going to be safe moving forward, and of course questions like what would actually happen if Schwab, the holding company of SCHD, was to see more struggle ahead and possibly even collapse. Well, in this article it says if rates stay stable or go lower, then Schwab will be fine, says former banking consultant Jonathan H., now president and manager of Integra Capital Management, a private equity firm. If rates stay elevated or go higher, then Schwab will likely lose their bank subsidiary because the financial forces will be above even their ability to finance, he adds. 100 basis points above the previous 10-year Treasury peak would be enough to cause a client exodus crisis. Absent a serious capital raise, he cautions, if a crisis at the bank goes out of control, it would damage the entire entity, primarily through loss of business, he adds. This article also goes on to say Schwab can sustain more rate hikes from the Federal Reserve, Wrong says via email, thanks to a couple of factors. The bank's security portfolio is largely tied to long-term interest rates, not the short-term rates that the Fed Reserve directly controls. But it's possible that the Federal Reserve raises the federal funds rate, but the long-term rates don't move all that much. Now, an example of this is that the Fed funds rates currently increase 25 basis points, but the 10-year Treasury yield is down 40 to 50 basis points. So even though the more near-term short duration change more drastically, the longer-term duration don't move as much. Now, also important to note about Charles Schwab is that Schwab has other strengths too. An estimated $100 billion of cash flow from a mix of interest payments on bonds, cash on hand, and net new assets likely to come throughout the year. It can also raise $8 billion a month in broker deposit CD sales, the WSJ reports, but that comes with its own risks, of course. Schwab also has access to over $300 billion in liquidity from short-term debt facilities, including the Federal Home Loan Bank, or the FHLB, and the Bank Term Funding Program, launched after the whole Silicon Valley Bank situation happened. Now, just thinking for a second, worst case scenario, in the case that Charles Schwab goes under, and SCHD of course being under Charles Schwab's umbrella, if you will, what would happen? Well, this right here says it's unlikely that Charles Schwab Corporation will go out of business anytime soon. Analyzing the issue from much longer term perspective will create a different answer. However, corporations can change over time. If Schwab ever did file for bankruptcy, remember that both its banking and investment divisions are protected by FDIC and SIPC respectively. This means that deposit accounts are insured up to $250,000 per depositor, and brokerage accounts are protected up to $500,000 according to number of shares, not share price. When a brokerage firm does go out of business, it typically is sold to a rival company. Very similar to the whole SVB and First Republic Bank situation. Earlier this year, we saw multiple banks go under, and they were sold to bigger banks, and it felt like it happened almost immediately. So if Charles Schwab did go out of business, your Schwab brokerage account would most likely be transferred to another brokerage firm, and your Schwab deposit account would move to another bank, all without much fanfare. So in the end, there's not much to worry about. Stock prices are another story altogether. So although that sort of clears up the entire story on the back end, with some of the reality as far as Charles Schwab and the issues that they're facing and what could possibly happen if Charles Schwab would see more pain ahead and possibly even go bankrupt. But that still doesn't solve the fact that SCHD shareholders are down 2.23% year to date, and this is of course due to a number of reasons. Regardless of all the issues, it also doesn't change the fact that there's still massive amount of inflows going in as far as SCHD ETF over the last few weeks. Hundreds of millions of dollars, more or less averaged out every single week, is still being added into this popular ETF. But because of the Schwab US Dividend Equity ETF's overall breakdowns, the exposure to things like industrials, healthcare, and financials of course, and a list of top 10 holdings that haven't necessarily performed all that well over the last few months. The SCHD ETF has not had all that great of a start to the year. But that being said, if investors just take a second and zoom out and look at how the Schwab US Dividend Equity ETF has performed longer term, this ETF is up over 182% over the last 12 or so years, and these are not even dividends included. So for me personally, as of right now, I'm not scared at all about what's going on with Charles Schwab Asset Management or the SCHD ETF to begin with, because when it comes to investing, for the most part, I look at things on a 10-20 year time frame, and I think SCHD and Charles Schwab are going to be doing just fine long into the future. But I want to hear from you guys down below when it comes to the Charles Schwab controversy of layoffs and the unsure future of SCHD. Are you currently still buying shares of SCHD as of now? Or instead, are you choosing to stay away from this ETF? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.